Hello, everyone. Good afternoon. Welcome to this webinar hosted by ValueQuest. My name is Abhinav, and alongside me, we have Ravi and Samir on the call as speakers. Ravi is the founder, CIO, and fund manager for VQ Platinum PMS and VQ Faster Cap AIF. Samir is the co founder and fund manager for VQ Growth. Many of you on the call would be existing investors or stakeholders with us. So, at the outset, let me thank you on behalf of our entire team for reposing your faith with ValueQuest and for being a part of our journey over several years. Since our flagship strategy, VQ Growth, was launched in 2010, we have scaled many milestones in terms of size and product breadth and delivered significant and consistent alpha. Thanks to your support, our assets under management are approximately around 18,000 crore now. We have crossed an inflection point in our product strategy. Going forward, for new products, we will be focusing on AIFs across the listed and unlisted space. We remain committed to delivering the best investment experience to all our clients and stakeholders. The agenda for this webinar is to address the key question that many of you have regarding market levels, recent events, and future expectations. Are we in a secular bull run that will have small intermittent corrections, or is a crash imminent? The title of this call is Markets at Crossroads, Decoding the Bull versus Bubble Debate. And with this, I hand over the call to Samir. Over to you, Samir.
Thanks and good afternoon, everybody. Thank you for joining in. I'll dive straight into this. First, the disclaimers, as always, that this is purely for education purpose. This is not a recommendation to buy or sell. We are doing this, purely for information purpose. So please take whatever advice that you take before investing. So yeah, this is like like Bollywood. This is a sequel to the webinar that we did in 2021, where the title of the webinar was Bull Market or Bubble, and the conditions at that point of time, obviously it was COVID time. Nobody knew what was happening, but the markets were going up, and we were posed with similar kind of questions that is there any merit to this? Is this a bull market or a bubble? So in recent interactions or whatever we keep hearing, everybody seems to be trying to predict the top and trying to predict the correction. Some of them also calling a crash. So that's a pertinent and a key question which we are trying to answer through this. That what is the likely scenario? So, back in 2021, we had a situation where a lot of uncertainty was there because of COVID. But in terms of asset classes, Bitcoin, SPACs, etc. So, at that point of time, these were the concerns. The SPACs, as Bitcoin was going through the roof, Tesla was doing well, and everybody was calling it a bubble. The kind of vertical rise that some of these asset classes saw was phenomenal. Non-profitable technology index. At that point of time, companies making losses. The number of companies which were delivering fantastic stock price returns, whereas the profits were not there, just zoomed during that period. SPACs, the number of SPACs IPOing was way higher than whatever it was in history. CAPE ratio was about 1929 level. So, all risk factors were flashing red. The Buffett indicator, which is market cap to GDP, also had gone. And see, in the journey of a bull market, you make a lot of all-time highs. So, the newspaper headlines will say that, world market cap to GDP was at all-time high, and that was seen or spoken about as a reason for correction to set in. Negative yielding debt around the world, and it was, for a very long period of time, it had zoomed materially. And then there were experts who were, calling the bubble and calling the crash, waiting for the last dance, the famous report of 21. So, and this is what we had said, Jeremy Grantham, for example, has been wanting to, call a crash for almost a decade. And we've seen what kind of a bull run US market saw at that point of time. So our view post-COVID has been emphatically that COVID is not the needle that pricked the bubble, but it is actually the fuel that fed the fire. And while it was a kind of a K-shaped recovery, but there were some trends which got materially accelerated because of COVID. And, if you add the kind of money printing that happened at that point of time, it was actually the fuel that fed the fire, and which really, put a tailwind for the stock markets to do well. Indian markets also at that point of time, 24th March, I think the market bottomed, and in a year's time, the market had done phenomenally well. And, you can see the V-shaped recovery and, market going above the pre-COVID levels. So there were concerns again, for India. This is everybody's favorite metric in terms of valuations, which is the Nifty forward PE, and 16-17 was the very long period average, and we were trading at about 20 times, and everybody was calling it that valuations were high. And that perennial question, are we there yet? Have we reached a level where correction will set in? And at that point of time, our answer was an emphatic no. Market did climb all these wall of worries, and if you see, from COVID, this is a 5-year chart of BSE 500, and the kind of returns that we have seen from that level, the index itself has more than tripled. Portfolios have done phenomenally well from that point on. So along the way, it's not been, economically, it's not been all good news. In fact, if we go by newspaper headlines, you always had something or the other to worry about every year. Fiscal largesse, how the governments actually responded to the crisis, to the pandemic, was to print more money, give more money in the hands of people, to avoid the, kind of to have a soft landing or to avoid a hard landing. And every government in the world expanded the balance sheet, printed more money, took more debt, and tried to, give money in the hands of people to avoid any kind of a crash landing or a hard landing. So fiscally, every government balance sheet expanded. This money given in the hands of people resulted in, obviously, the spending remaining high, and there was a supply side disruption that the world saw, which is why we saw a kind of inflation. So demand remained steady or high, and supply side disruptions happened, because of which global inflation soared. Because the inflation soared, central banks around the world had to take notice, had to take some action. So we saw unprecedented 2021, 22 saw unprecedented rise in interest rates. We saw, 30, 40 years of negative zero interest rates. And suddenly in a short period of time, US interest rates had to go up from 0% to 5% kind of levels. Now again back down. But across the world, central banks had to respond to the inflation threat, and demand obviously continued to remain strong. And the response from the central banks was to raise rates. That, because of the fiscal spending that the governments were doing and interest rates going up, so the government debt to GDP kept going up. We hit a record level of 350% of GDP in terms of global debt, and the interest rates actually made the interest cost soar up materially. So this was a big problem that the governments had to deal with. Uh, there have been multiple wars while it has been, not the Western countries, or the talk of world war has been now going on for a very long time. We have an economic war. We have these actual wars that are happening: Russia, Ukraine, Middle East, etc. And that has also been a cause of concern for last few years in terms of what kind of an impact this can have on the market. The wars did disrupt, whether it is crude, coal, freight rates, etc. Everything got disrupted along the way. Freight and commodity volatility we have experienced last 2 3 years. So these are global freight rates. It went up, then again normalized now because of war. They went up again. China real estate is the big problem. The real estate sector in China has imploded. It has the highest debt, and it used to contribute highest to GDP. So they had gone on an overdrive in terms of building real estate, and now they have a problem on their hands. Though it's totally funded by the government. Even yesterday, Chinese government has taken some more measures to fund real estate, or give some more liquidity so that projects can be completed, etc. But no measure seems to be enough. So China has a slowdown problem, and it has big debt as well. And then there are these trade related issues that everybody has with China. So that has been a real cause of concern, and people have been worried about it. Again, this is one reason why a lot of people have avoided putting money in the market, even lately, and I'll come to that. Along the way, we had US banks, Silvergate, Silicon Valley Bank, which, kind of 3 days time, the bank went belly up. Credit Suisse scare that we saw. UK in their mini budget tried to spike the yields, etc. And the government of the day actually, the prime minister had to actually resign because of the fiscal policies that are very, uh, created havoc in the currency, and those measures have actually not worked. So uh, the worries about world ending, or the bank problems or central bank problems have always been at the forefront. Coming to domestic issues, we've seen a consumption slowdown, which was mainly on the rural side of the economy. Urban has been on and off doing pretty okay, but rural side of the economy has been struggling. We have an unemployment problem. Large part of our population depends on agriculture. With the rural stress caused by the pandemic, it is going to take time for things to revive. Indian government did not take the action that the Western governments took in terms of giving money in the hands of the people. So Indian policies have been vastly different from Western world, which means that you are taking some bit of near-term pain in terms of not handing over cash. But it was good. They focused on the supply side when the entire world focused on the demand side. We had a mini political setback in the general elections recently, that where the widely expected majority to the ruling NDA government did not happen. They barely scraped through, but finally, I mean, obviously, they were the single largest, and they formed the government, and we have stability, but it was not to the extent, the mandate was not to the extent of what was widely believed. And post election, in the first budget, we have seen a hike in capital gains tax. Again, something, it turned out to be a 1 day thing, but yes, on both these days, whether it was 4th of June or on the budget day, there was a mini scare to the market. Then this recent thing about Chinese stimulus and FIIs pulling money out of Indian markets and putting money. So this is since October, $7 billion and counting has gone out of the Indian market. So again, this worry about money moving out of India to China because of valuations, etc. Valuations obviously is the elephant in the room. The general, again, newspaper headlines and anecdotal evidences have shown, some places where, you have 100 PE also and stuff like that, which is being touted, as very India being, obviously India is an expensive market as compared to the world, but valuation has been a constant source of worry for the market. And it seems that the market has completely ignored all these and continued to, dance in spite of such serious issues and such serious challenges. So let's try and decode. We are, at the same thing. This is a chart that I saw on Twitter just today. So, the same thing. The doomsdayers or naysayers are still, talking about that this is all a bubble and it is going to get pricked and we just need one event and the index will crash and markets will crash and stuff. So we are posed with the same question again that we were posed in 2021. Are we there yet? Is there a needle which will prick the bubble? Are we in a bubble and are we going to see a crash? And I'll hand it over to the expert to take it forward and answer all these questions. Ravi, over to you.
Thanks, Samir, for that. Let me just put up my screen. Let me know if you can see the screen.
Yes.
So I am no expert, even though Samir would like to say, but there is a framework that we used in the previous presentation that we did, and we said that we are nowhere near a bubble. And we are going to use the same framework to make a case that things look stretched from a short-term perspective, and we can have a correction. Maybe the correction has already started as well, but we are nowhere near a major kind of a peak, which can lead to major crash in the markets where capital protection can be an issue. One should be mentally prepared for a correction, and that we will do. But let me get into making the case for why we are not on the verge of a major crash. So according to the framework that we used, for markets to make a major peak, we will have to be at a peak economic cycle, peak earnings, and so basically that means peak growth and profitability, peak valuations, peak funding and equity raise, and peak leverage. So all, if those conditions are met, then we can say, and then when you see a needle coming from your blind spot and hitting, that will lead to huge amount of liquidity getting sucked out of the market, and that will lead to a major crash. That's what happened in global financial crisis. Today's conditions are not like that, and let's get into slightly more. This is a pictorial representation of what I just made. So there is liquidity cycle, there's earnings cycle, market cycle, economic cycle. We might be at various stages of this cycle, but nowhere near the peak is what we are saying. This is not the point of maximum optimism. In fact, as Samir pointed out, there have always been worries. One or the other thing has always kept the market on its toes and never let it, markets have never run away really with that. So let's come to the point, or why we feel, again, Indian macros have never been better. I'm not talking about the short-term lead indicators, which might be pointing to a little bit of slowdown in this quarter here and there. I'm talking from India's balance sheet perspective rather than from the P&L perspective. India's balance sheet has never looked better. So, and for for the first time ever, the finance minister of this country has said that it's not only fiscal deficit which will be the focus, but we will be focused on the reducing the debt to GDP. That makes India one of the only countries in the world where the debt to GDP will actually come down, while everywhere else the debt to GDP is increasing. So this particular slide essentially states that the conditions at which the global developed world is looking more like an underdeveloped country, while the way the India's balance sheet is looking, it looks more like a developed market. So our debt to GDP is low and reducing. hikes are actually moderate. We have been on a pause since a while, and probably there's a cut in the offing. Bank leverage is very, very low. Inflation is within range, 4% plus minus 2. We have not exceeded that in any significant manner, thanks to the low amount of fiscal stimulus given during COVID times, that our inflation still remains under control, and the relentless focus of the government on the supply side reforms, which ensures that the inflation remains low. There have not been much M2M losses for the banks. Deposits are very, very granular and well spread out. And our regulators, I would say, have done more than a good job of ensuring that there are no systemic risks, whether it is RBI as well as SEBI. Just to give you a perspective, a lot of people think there's a lot of, should I say it? There are a lot of shenanigans happening in the market, which might be true in some pockets, but not at market at large. I remember 20 years back, when to take a position of a 20 lakh in the Nifty futures, you need to have a 1 lakh rupee margin. Now, to take a 20 lakh position in the Nifty, you need to have somewhere between 5 and 7 lakh rupees of margin. That means your leverage is very, very low. You are only 3x kind of a leverage. So not only are the corporates not leveraged, but the market participants are also not allowed to take that kind of leverage. From a longer term perspective, the case for India has never been stronger in the eyes of the foreigner. Of course, there's a dichotomy over here, but despite these strong factors, FIIs have not been a big buyer. But there is no other country that has the kind of strong demographics that we have, the clean and lean balance sheet that we have, where the profit cycle has just begun 3-4 years back. For example, US has been in this upcycle of profit for almost 14-15 years now. And that is a challenge for them, where their corporate PAT to GDP is almost touching 13-14%. It peaked at around 15-16% last year and has come off a little bit, but it remains elevated. The inflation for them is far more out of control than it is for us. And our equity markets have become much more deep and broad. So all these are actually characteristics of an economy that is growing, characteristics of a market that is in depth and is providing an alternative to the other large emerging market out there, and which is why the case is very strong. And the only reason why FIIs have till now not invested has been valuation. But in my opinion, it will be unlikely that the valuations correct too much for them to provide a very convenient entry point. Not going to spend too much time on this. India has the strongest demographics. We all know that 65% of our population is below the age of 30 years. It is among the fastest growing working age population. This is the biggest tailwind that an economy can have in terms of growth. Of course, we need to ensure that they are all gainfully employed and the productivity levels are increasing. India's corporate balance sheet is very much deleveraged. It's at the 15-year low in terms of the leverage. So, and if we were to take only the top 500 BSE 500 ex BFSI debt to EBITDA, it is very, very manageable. Debt to GDP ratio in the economy is also very, very manageable. So these are the in a scenario where we were to have some kind of a correction, the not having leverage will ensure that it does not, what started off as an equity market correction does not end up being an economic contraction. These are 4 charts which I have been talking about in my past webinar also. The single biggest reason why I believe that India's bull market is not yet over. On the top left side, you can see corporate PAT to GDP, but you can see 3 different lines. Essentially, the blue line is the profitable companies. The yellow line on below is the loss-making companies, and the dotted line is the combination of both the profit-making and loss-making. So our corporate PAT to GDP, which bottomed at around 1.6% during COVID, has risen to about 5%. And the case that I have been making since last few quarters is that this time around we will actually exceed 7, 8, 9% kind of corporate PAT to GDP in the next 4 to 5 years. What gives me that confidence is that a lot of the the leading indicators or the growth drivers have not yet completely panned out. So whether it is as compared to the previous cycle, first of all, our corporate tax rate is much lower, which is 25%. In the previous cycle, when we hit a corporate PAT to GDP of 7%, our tax rates used to be 37-38%. Now our corporate tax rate is 25%. With cess and surcharge, it comes to around 27%. But it is still substantially lower than the previous cycle. So this time around, a bigger portion of the profits will accrue to the corporates as against to the government. Second, in terms of the PLI, all the production linked incentive scheme and which have been instituted in the last 2, 3, 4 years are all up ahead in terms of how that will lead to increase in production, and that incentive will all accrue to the corporate players. And some of the new greenfield capex that is happening at a 15% tax rate. So that also adds to more to the corporate profits. Second, in terms of growth, in terms of profits and profitability, we have still not peaked. So the operating leverage will pan out over the coming few years. Our utilization levels is around 76-77%. That means the moment it hits 80%, that operating leverage, that pricing power in the economy comes back, and these corporates will witness a meaningful improvement in their margins. So a combination of PAT rising, combination of ROE. The last time around, return on equity in FY 2007 peaked at around 25-26%. We are still at about 16% in terms of ROE. So one of the reasons is, of course, that the Indian corporates have not been open to leveraging. So let us presume that we don't reach the level of leverage that we saw in the previous cycle. Still, there is enough room for this 16% ROE to improve to about 20% or 21-22%. With that kind of scope available when corporate PAT increasing and ROE is increasing, there will always be pockets of industries where there will be opportunity, where the profit pools are expanding, and the moment valuations become attractive, there will be flows coming into it. So this India's earnings cycle is well and truly into the saddle, give or take a couple of quarters where we will see some kind of correction because of some election related issues or monsoon related issues or heat related issues, that we might see a little bit of slowdown, and markets can correct, and probably, as I mentioned earlier, the correction is probably underway. We have seen 5-6% kind of correction from the top. Can it correct another 10%? I cannot rule that out. In fact, I will not rule that out. But that 10% correction should be a cause of us getting more excited about it, because finally the allocation that we have been wanting to make in the market will get that opportunity which we haven't been getting. And in fact, if you see, some of the sectors have actually corrected more than that also. 30% odd kind of correction has come about in certain sectors. But the point of this cycle, this particular slide, is that the profitability and capex cycle has not peaked. The inflation remains under control, and RBI is in pause mode, most likely to cut in the next meeting. Indian markets have developed a lot of resilience, a lot of depth. In 2008 global financial crisis crash, a $20 billion outflow in a span of 9 months led to a 65% drop at the index level. In post the Russia-Ukraine war, from October 21 to March 23, we saw $40 billion of outflow in a 15-month time frame. So that is almost double in a slightly more time period, but still $40 billion of outflow led to a 16-17% kind of a correction. Now, that is the kind of domestic flows that we have developed. Now we are not so much dependent on the external flows to drive our markets and our returns. So that has been the story of the last 4 decades, that Indian retail as well as the wealth generation that's happening in this country is finally come to the fore, and it's providing the counter-cyclical measure to the FII selling. The breadth of returns in India has always been good. The maximum number of multi-baggers in the last 25 years across the world has been in India, almost 54%, as against probably Australia is the second biggest with 35%. And these multi-baggers have not come in the last 4 or 5 year period. In fact, across the last 25 years, you will see that there have been some or the other companies that have always been performing. So the distribution of the returns is pretty good in terms of number of companies and in terms of the time period as well. Rupee has been one of the most stable currency in the emerging market basket. Yes, it's been on a depreciation trend, can't deny that, but the long-term fundamentals of Indian economy are changing, and someday that realization might dawn that India probably doesn't need to have a depreciating currency. The reason being that, see, the biggest reason why India has a weakening currency is because we import all our most of our needs. So one is we spend more than what we earn, and second is we buy from the world more than we sell to them. Those are the two reasons why for our rupee has constantly been on a depreciating curve. But going forward, our energy import needs are going to come down dramatically. Our electronics is already becoming a net exporter nation, so it has already reduced. And on the revenue front also, government's tax collection, because of the formalization of the economy and because of GST, our tax collections have never been better than this, which is why the deficit is narrowing. Of course, we are still few years away from reaching a point where the deficit completely vanishes. In fact, I would say it is not even healthy to have that. Some level of deficit we should maintain, and some level of inflation we should maintain, because finally we need nominal GDP growth. And for that, if some compromise has to be made on that, it's absolutely fine. But the larger trend that where we used to see 20-30% kind of depreciation in a very short time frame, where we were totally at the mercy of the foreign flows or global flows, that is an era of the past. In fact, the volatility in rupee has completely vanished in the last 2.5 years. Yeah, so I mean, this is the slide I should have kept while talking about it, but the stable and improving CAD is because of the aggressive targets for domestic energy sources, focused policy action on self-reliance. We will be at 4.5% kind of fiscal deficit year down the road. And our current account deficit is also not so much out of control at this stage. India is only the fourth country in the world to have $700 billion of forex. In fact, there are some good economists now. I am not an economist, but there are economists who are arguing for the fact that we should not be having such high forex reserves which are not yielding any returns, and we should be slightly more aggressive about it, and maybe let our currency appreciate a little bit and diversify our basket of where the money is kept. But I will leave that to the economist. I will focus more on what the government or RBI action is, rather than trying to be prescriptive about what they should be doing. At this juncture, because we still continue to hold so much reserves in dollar, is what gives the US dollar the strength to continue printing. There will come a day of reckoning, probably not now, maybe 5 years, 10 years down the line, where governments might lose their confidence in dollar as the reserve currency of the world. But I don't have to worry about that at this stage. So we will park that for the moment. I'm sorry, I seem to be going reverse. Yeah. So few things have happened in the last few months where actually the focus, because of the inflation coming under control, because of the deteriorating circumstances, the actions of the governments have, and the central banks have now shifted towards providing support to the economy rather than towards slowing down the inflation. So there has been a dramatic change, as we can see that 24 rate cuts, but 24 different central banks have announced rate cuts in the month of September last month. Global money supply has again started accelerating. So the monetary and fiscal conditions. So one of the things that have bothered me a lot, or a lot of our co-investors, is that despite the fact that interest rates in US went from 0% to 5%, why did US economy not face a recession, or why did the markets not crash? it's because there are two tools in the hands of government and central bank. One is the monetary policy, other is the fiscal policy. The fiscal policy continued to remain loose while the monetary policy was tight. Now that the fiscal policy is being receded a little bit, the monetary policy is beginning to be loosened up a little bit. So the objective of the central banks and the governments of the world is to ensure there is a soft landing and not a crash. And they, at this point of time, it looks like they seem to be succeeding in their objective. But we will keep our eyes and ears open to see whether things go out of control for them. At this point of time, the scenario for soft landing seems to be the base case. Then, of course, the big elephant in the room is the big election that is up ahead. But from India's perspective and from Indian markets perspective, honestly speaking, whether it's Trump or whether it is Harris, it seems to be more of the same, which is more spending, revive the economy, and move away from China. Both the things are having a strong US economy and having in US on your side as a trading partner as against China. Both things play in India's favor. So for us, it is less of an issue. But of course, whether this Trump administration comes in or Harris will determine probably the nuances of which sectors might end up doing well. To that extent, we might have to keep our eyes and ears open where the priorities lie for Trump versus Harris. China has been suffering, and the result of that has been that Chinese economy came to a grinding halt. We have seen videos of dead ghost towns all across China. The real estate is the core of the problem in China, and they are trying to take steps. Whether the steps that they have taken are they enough to revive the economy? I will not hazard a guess to that as of today. But it seems to me that at least the realization has dawned on them, and they will definitely try. It might take some more time, and it might take some more effort, and they might have to bring out even bigger bazookas before the economy revives. But it seems to have put a floor, at least in the Chinese equity markets. And that lot of people are making a case out that if money flows to China, then money will not flow to India. I find that a little silly argument, because most of the money flowing into China is not flowing through China dedicated funds, but it is flowing through emerging markets basket. And in emerging markets basket, the Chinese weight is are pretty equal. So every dollar that goes into the emerging market basket will automatically find 20% being allocated to India as well. Even if you want to stay underweight or neutral, you will end up allocating 15, 16, 17%. So money coming into emerging markets will be beneficial for India as well. In fact, the large trade for the last 14, 15 years has been buy US equities and sell emerging market basket. India has actually done well in the last 4 years, primarily because of the domestic flows and not because of the foreign flows. So yeah, so now again, even China, which is the other major economy, is also trying to revive the economy. Oil prices, which has been the bugbear for India in the past, the prices have been quite stable, and the longer term headwinds are well and truly in place for the oil. In fact, I would like to say that crude will probably find it very hard to sustain above $100 a barrel unless there are dramatic cuts in the production. At the current level of production, I think it is this 60 to $80 range seems to be the kind of a equilibrium where India will be also happy to pay that kind of price. Actually, it's not bad, because even Indian government derives a lot of its taxation revenues from the crude. So we saw that we did not benefit a lot when crude prices fell, because our government kept increasing the excise fee, which a lot of people felt bad about. But I feel that was a very smart economic move, because you were able to use those resources at that juncture when and shore up your reserves, while the most of the governments in the developed world actually went overboard and provided fiscal stimulus. So we maintained fiscal discipline, and we showed up our resources when the crude was falling. So now if the crude was to spike also in case, I feel government has that, in fact, they've already affected one cut already, but they still have some buffer in terms of cushioning the rise in crude prices. Yeah, I mean, what I just said, that crude prices have been stable, flows have remained strong. In FPI flows, I think I think the election result, there was some pickup till September, and September saw a big inflow, but then October ended up reversing all of that flows that came in the month of September. So from what it seems right now is that FIIs are still very much concerned about the valuations in India, which is leading to them wanting to take bigger stake in India, but they are unable to, and they are waiting for a correction in the market. And that, I believe, provides a natural floor at some point of time to the Indian market. Biggest argument in favor of why we might see a correction but not a crash is one, that we are not leveraged. The Indian corporates are not leveraged, and the second biggest challenge reason is that the FPIs are not heavyweight on India, and most of the crisis at this point of time seems to be originating from out of India, and that might lead to some amount of collateral damage, but it will not be too much of a damage, is what I feel. Domestic flows remain strong. We are now witnessing almost 40,000 crores kind of a monthly inflow. A lot of people tend to focus on the gross SIP number of 25,000 crores, but that is a misleading number because the net inflows are actually only 9,000 crores. But in the entire basket of flows coming to India, SIP is still only 20% of it. The non-SIP flows are almost 80% of it, and that adds up to 40,000 crores. That is, I mean, that is like $5 billion a month, almost $60 billion of money coming in. Now, if I were to just give a back of the envelope calculation, I feel even 60 billion is a low number. India is a $3.5 trillion economy. We save about 24-25% of the GDP. So that translates into roughly about say $800 billion kind of savings, out of which we are seeing $60 billion a year come into Indian equity markets. That still remains at around 7-8% kind of a number. Now, 8% is an increase from the 5%, 6%. But is it something that should be a cause for alarm? I don't think so. Most of the developed economies have almost, where the almost 30 to 50% of their population is exposed to equities, versus India, where still about only the 14-15 crore demat accounts, out of which about 8-9 crore unique demat accounts. So even if I were to take 140 crores population, remove about 50% of the population, which probably does not have the investable surplus, even from the rest 50% of which is at about 70 crores, we are only at about 8-9-10 crores. So there is still a long way to go before we reach a stage where we can say that Indian retail and Indian public is very, very exposed to equities, and a downturn will cause a contraction in economy. Nothing of that sort is on the horizon right now. This chart depicts what I just mentioned, that from the high of 22-23% FII ownership, it is now down to 17.6%. And now of the free float percentage, in fact, domestics own as much as foreigners in terms of the Indian equities. 30 to 40 billion, we are now expected to have $80 billion kind of a flow. That is the kind of domestic flow that we will witness. It's huge. And good thing for us is a lot of IPOs will also come. So a lot of people are worried about the kind of supply of paper that we will see. But I feel we have the required flows also to counter that paper supply. In fact, all the money, even from the FPI and from the DII, which is waiting on the sidelines, will be happy to participate in good quality IPOs where the valuations can actually be negotiated down, while in the markets you have to actually depend on whatever market is giving you. But coming to the elephant in the room, valuations, at the headline number, absolutely no significant overvaluation at the aggregate level of Nifty. We are at 21.5, which is above long-term 10-year average. Yes, it is. But are we in a bubble zone? Nowhere close to it. The trailing P ratio for MSCI index versus MSCI EM is at a premium, yes. But is it at preposterous level? Definitely no. our premium, in fact, to the emerging market has come down a little bit from in the last 2-3 years. So that is also a good thing. So all these relative worries versus the world are actually receding a little bit. 1 year forward P of Nifty 50 and NSE mid cap is at a reasonable level. I mean, probably on the mid cap side, it is slightly on the higher side, but at the Nifty level, it is not so much of a worry. And in fact, the aggregates tend to hide more than they reveal. So if you were to take a few sectors out, NBFC, capital goods, healthcare, and if you see that those are the sectors actually which are still at the beginning of an upcycle, they might look overvalued from the perspective of the P multiple on a trailing basis, but usually what the thing to look at is the cyclically adjusted P. And if you see if the cycle is just beginning 2 years or 3 years out, these are still very, very reasonable valuations. It does not mean they cannot correct. But again, there will be a buyer at a level at some point of time if they were to correct 20-30% these sectors. US markets are actually trading at a premium to India. It's not happened too much. We are a small cap in the world. In a 125, $130 trillion world market cap, US is 60 trillion. We are barely touching $5.5-6 trillion. But $5.5-6 trillion for us is definitely a new high that we have made. And as a percentage of the world's market cap, we are now at around 4%. We have always been in the band of 2% to 3.5%. And this is the first time that now we are at 4% of the world's market cap. And my gut feel is that this time around we'll definitely manage to keep it above 3.5-4%. In fact, can make a case that in a 4-5 years time we can actually go on to become 5-6% of the global market cap as well. Market cap to GDP seems like an elevated number, the Buffett indicator that Samir spoke about. But honestly, I find this to be a slightly shorthand. This not a very good indicator of how the market is going to behave. One, the composition of GDP has changed dramatically. In fact, for US, this is more than 210. To give you an example of Hong Kong, Hong Kong's market cap to GDP is more than 6-8x because Hong Kong has the exchange where all the Chinese stocks are listed. So market cap to GDP is not necessarily a very good indicator of what is going to happen to the market. We have to look at corporate PAT to GDP and we have to look at corporate ROE and whether the trend is improving over there or no. But having said that, market cap to GDP is on an elevated level. Can it correct a little bit? Yes, it can correct. Earnings growth in India are much higher versus the globe, and which is the reason. So if we have an improving corporate PAT to GDP, if we have improving ROE, we have the depth and breadth in the market, and our earnings are growing faster than most other countries in the world, then for sure we will get the premium that we are getting and we will sustain those premiums as well. Coming to the question, the 3 years back, the debate was bull versus bubble. Today, the debate is crash versus correction. And clearly, we are in the camp which believes that there is no crash in the offing. There can be a correction. And the reason I already mentioned, the framework that we look at is it's not a peak economic cycle. It's not peak earnings. Valuations, you could say it is not exactly in our favor right now, but neither is it. The peak valuations to peak earnings is what one should be scared about. The peak valuation multiples might be on a high, but the earnings are not at a peak. And this is not peak equity raising as compared to what most people believe, because there has been so much promoter selling and because there have been so much private equity and everything selling, people feel that there has been too much of equity fundraising. But I will show you a data point which says that this is not peak equity raising. I think this year, the number of the amount of money, rather the amount of stocks sold by the promoter will cross 2 lakh crores. And 2 lakh crores is not a big number. You should expect it to be an annual number. And we are not at peak leverage. These are some of the instances of the past peak where, the market cap to GDP, the PE, corporate PAT, last 5 years cumulative returns, CAGR returns, ROE, what is showing today as an indicator are not at peak level. The combination of this is what is telling me that this is not a market that is going to crash by 50%. And at index level, we can correct by 10-15%. At sector level, we can have corrections of 30%, and stock level, some of them might correct a little bit more and can have 40-50% kind of correction. Those might sound like scary numbers, but corrections are a feature of the market. They are not a bug. One has to take advantage of that volatility. As Morgan Housel says, all past corrections look like an opportunity, while all future corrections look like a threat. So, and people, those who have been waiting for correction for the last 18 months, have missed out on a lot of wealth creation. Surely, it might be the case that we are sitting in the middle of a correction that has just begun, but we will have to live through that. We'll have to digest the gains that have been seen in the last 1.5 years as well as in the last 4 years. Once that digestion of the wealth creation is done, is when we will see new leg of wealth creation, and that might be taken care of by a little bit of correction or a little bit of no performance from the market. This is not a peak economic cycle. As you can see, the gross capital formation, which peaked at 36% in the 2008 cycle, fell all the way to around 26-27%, has bounced back to around 31%, but we are nowhere near the peak that we witnessed. In fact, there is a lot of scope to run. The entire private sector capex cycle is ahead of us and not behind us. It has been only and only central government which has been driving the capex cycle till now. And in fact, that capex cycle, government capex is only 20% of the total capex cycle. So the big needle mover is ahead of us and not behind us. The corporates have made fantastic money in the last 3-4 years, and they have not invested enough for the future, and they have not taken enough leverage to invest for the future. Lot of the future expansion is actually being funded by equities rather than through the debt. So we are still far away from 7% plus profit to GDP in 2007. So this is the data point that I was talking about, why this is not peak equity raise. In 2007-8, our market cap peaked at $1 trillion. The equity raise we saw in the year 2007 was $30 billion, which was 3% of the market. In 24, our market cap is $5 trillion, and the equity raise is going to be between $60 and $80 billion, which works out to 1.2 to 1.5% of the market cap. As long as this number does not reach 2.5, 3.5% of the market cap, I don't think we can say this is peak equity raise. And this is despite the fact that the corporates have not taken the path of taking leverage for raising money, but it is the equity that they have been choosing. Yeah, so repeat of some of these charts. It is not peak leverage. Valuations are high, but that does not mean we'll have a crash. In fact, we have already had corrections. It's just that now we are forgetting about it. At the beginning of this year, in Jan-Feb, mid-cap space saw a very decent correction. Since this cycle has begun in the April and May of 2020, we have had several corrections ranging from 7-8% to 11-12%, and the deepest being 16%. But still, and can we have another of those corrections? I can't rule that out, but it's not a 30% kind of a correction that we are sitting on the verge of at index level, or across the board 50-60% kind of shaving off of market cap that we will see. There might be some pockets, and we have to stay away from that. So I see opportunities as well as landmines in the market currently, and we'll have to take advantage of the opportunities, and we'll have to avoid the landmines. We feel the base case is turning out to be a time correction or a price correction or a sectoral correction, a sectoral rotation, rather than a major correction in the market. In fact, if I were to just dial back and go back to Jan-Feb, had you told me in February of that year that this government is not coming back with a simple majority, and in the budget they are going to increase the corporate tax LTCG from 10% to 12.5%, and short term from 15% to 20%, I would have told you these markets are going to crash. And on top of that, there is going to be an outbreak of a war in the Middle East, and which has the potential that Iran might get involved at large, and there is a possibility of a nuclear war had you told me all these things, I would have said the markets are going to crash. But on the other hand, what's happened, as you can all see, is markets have actually rallied. So never know what markets take cognizance of, which leads to a correction in the market. But if we stay focused on the economic cycle, the corporate earnings cycle, and the kind of opportunities presented to the Indian corporates, then you will know that all you have to do is determine what valuation are the at which you will be a buyer, and always being focused on the negatives and the concerns will actually take you away from the focusing on where the opportunity lies. So it's just the mindset difference. I'm not making a case that one should be going all out. This is the time to be putting all your eggs into equity markets. No, you have to be circumspect about the market and the valuation, but at the same time, not run away from the equity markets. That's the point I'm making. So constantly looking for a top is counterproductive. There are so many decadal themes unfolding in front of our eyes, which are keeping us excited. And today I sit at a vantage point which I have never had in the past, where I get to see what's happening in the private equity markets as well as what's happening in the public markets. And the moment I take that prism of private equity market, and I can see that these corporates have a great runway ahead of them. There are companies are growing very fast. All I need to do is ensure that I am not paying for that entire growth at this point of time for 3 years out. And if the valuations can be negotiated, I don't see a reason why one should not be bullish on Indian corporates and Indian economy. So energy transition, electronics manufacturing, China plus one, private capex cycle uptake, domestic consumption upcycle, US Biosecure Act. These are some of the opportunities which we feel remain very fertile ground for us to be picking stocks. However, in that 10-year horizon, what seems very positive to us, we still have to see whether it makes sense in the 3 to 5 years to be making money. So, for example, the listed defense area, we might have been bullish on it from a 10 years perspective, but from a 3 years perspective, we thought it was factoring in a lot of the future, and that's why we exited some of our defense bet 6-9 months back. So yeah, but again, with a 30% correction, 40% correction, we might be open to relooking at it as well. So nuances required while looking at current valuation. We are at the beginning of a cycle with operating leverage is still to play out. A lot of sectors will see profit pool expansion and new winners will emerge. Exciting earnings growth in a lot of sectors is ahead of us. Financial leverage is still very low. ROEs are on an improving wicket. From 16% can go to 20-22%. Cash flows remain robust, and corporate tax is low. In this kind of a scenario, again, these net profit margins, we are not at peak yet. Operating leverage is not yet peaked out. New upcoming sectors are distorting the headline multiples. A lot of these companies are trading at a multiple which gives you a heady feeling, but it is overcompensating probably for some of the old sectors where there is no earnings growth, and actually it might be the case that these new age sector might be undervalued despite the high optical P multiple, while some of the older sectors might be overvalued despite the low P multiple. Let's not use absolute P multiple as our measure of valuation. It's a shorthand, but it is not the only measure. You have to look at it from the perspective of where we are in the cycle, in the sector and cycle in the company, where the triggers of the profits and profitability and the drivers of profits are still yet to pan out. Then in that kind of a scenario, unlikely to see a major correction in valuation. I will just dial back a little bit and give you examples from my personal experience when I experienced global financial crisis on my own. And at that point of time, this was peak in Reliance Power, IPO was coming, and it looked like the housing crisis in US had already started, and India was running on fumes from the period of September of 2007 to January of 2008. For that 4-month period, the crisis had already hit the world, but we were still in our own merry world, and there was a lot of money being raised at that point of time. Now, the conditions were ripe for us to take money off the table, run away from equity markets. And we took that call also. In my personal portfolio, I would have gone into 50% kind of cash. And 50% seemed a high number to me at that point of time, that, I'm fantastic, I've created 50% cash. But 50% of that correction, and I stayed invested in the 50% of the portfolio. What happened is, in 9 months' time, the 50% that I was allocated fell by another 50%, and my portfolio took a big hit at that point of time. However, one stock, I will give an example of one stock. I used to own a company called LIC Housing Finance that peaked at around 400 rupees in 2008 and fell all the way to 200 rupees in the global financial crisis. That's a 50% crash. I stayed invested because I believed that the housing opportunity was just unfolding. The valuations were still very cheap, and the absolute market cap of the company was not that bad. So everything pointed to the fact that I should stay invested. In a 2-year time frame, right after March 2009, from March 2009 bottom, actually less than 2 years, in 15-month time period, that 200 rupees stock went to 1200 rupees. So when I felt very stupid when the stock fell from 400 to 200, but I would not have been able to ride from 200 rupees to 1200 had I tried to be very cute about timing that correction, which was not a correction, it was a crash actually. So everything said and done, it is great if you can identify a crisis, create cash ahead of it, move completely into crash, and move completely into cash and re-enter right at the bottom. But nobody knows where the top is, nobody knows where the bottom is, and if you constantly stay in the zone that you are looking for a top or looking for a bottom, you will most likely miss out on the next move that the market is going to present. So this anecdote I am just saying to make you aware of the kind of things that happen, and even if you get a particular move in the market right, there is no guarantee that you will get the next move right. Still the smartest thing to do is to stay invested, because corrections are a part and parcel of the market, not something to be scared of, but to be taken advantage of. The exciting earnings growth is ahead of us, leverage remains low, ROEs are on an improving, operating cash flows are very robust. So coming towards the end of the presentation, the correction that is upon us because of the overvaluation will shake weak hands out, and it might lead to some sort of sector rotation. We have to get that sector rotation right. Even though we are not bearish, we are still sitting on a decent amount of cash. Across the board, we are sitting on more than 10% of cash. In our new fund, we are sitting on almost 90% cash. So the correction is something that I am looking forward to, not running away from, because I am also looking to build a position from a position of strength. A 10 to 15% market correction with earnings roll forward to FY26 should take care of the valuation. So coming to the question that Samir left this presentation at, which is, are we there yet? Is this the needle that has pricked the bubble, and are we going to have a crash? The answer is emphatically no. There is no crash in the offing. There will be a correction. We have to invest for the long term, invest with reasonable return expectations, keep some powder dry, and stagger your investments. That's what I've been telling everyone, and I would like to repeat that navigating this correction is something that we are keen on doing, but at the same time, we don't want to time the top and the bottom. Thank you so much. With that, I'll end the presentation.